Okay, this is Chapter 8, Risk and Rates of Return. This is a great chapter because it's going to cover portfolio theory, which is an integral part of investment management. And anybody in a business program ought to know something about portfolio theory. To start off, we're going to talk about rates of return, and then we're going to talk about risk. And then we're going to blend the two together because you can't really talk about risk without talking about return, and you can't really talk about return without talking about risk. So let's dive right into this, and we're going to talk about three types of returns. Three types of returns that are addressed in your textbook, and then I'll talk about two types of risk. There's actually more than three types of returns. There's actually more than two types of risk, but I'm going to try to summarize it as high level as possible, and then we'll get into more details. The first type of return that's out there is an expected return. An expected return is the return that you expect to get on a stock. You don't know what it's going to be yet, but you expect it. You're anticipating it. That's going to be denoted as R hat in the textbook. And an example would be, let's say you buy Apple stock at 100 and you expect the stock 1 year from now to be 110. Okay? And you also expect a $2 dividend 1 year from now. What would be your expected return for Apple? Well, it would be R hat for an expected return. You could put a little A here for Apple if you'd like. And then what it would happen is you take the ending value plus the $2, because you expect to have value of 112 when you're all said and done at the end of the year, minus the cost of 100 divided by 100 is 12 over 100. That's 0.12, 12%. You expect 12% from this particular stock. So that's an expected return. We'll be using that a lot. I'll be showing you an example in a few minutes on it. Another type of return that we will use and we'll refer to in this chapter is realized rates of return, or in other words, past returns. So if you bought Apple 10 years ago and you held it for each of 10 years, what would be the average return over those 10 years? Well, we would label that R bar because it's an average of 10 years worth of returns. And so those are realized. This is looking backwards in time. Expected returns look forward in time. Realized returns look backwards. Now in finance, we don't have, I don't have a crystal ball. It's very clear. And so it's really hard to figure out what expected returns are. If I knew that, I'd be a billionaire. So what do I and what do most people in the world of finance do to help guide them as to expected returns? They look at realized returns. They look at historically, what has this stock done, and try to use that as a gauge for the future. But it's kind of a bit like driving your car looking through the rearview mirror. As soon as there's a turn in the economy, a turn in the market, you're going to go off the cliff because you're not looking in front of you, you're looking behind you. So it is just the nature of finance. People want to look, they don't have a crystal ball, so they're looking back to see as for guidance. So you look to history. The third type of return is required rate of return. If I can spell it. And that's denoted as plain old R in the text. And sometimes it'll be like an R with a little A here for Apple, or R with a little I here for individual stock I. And what that is, when you hear the word required, you're going to immediately think, okay, required rate of return given its risk. So as soon as you hear the word or read the word required, you think risk, because it's the return that you require given your risk aversion that you have and how nervous you are about risk. What is the return that you require? And then that is the required rate of return. We're going to have a whole model that'll help you, that help us to figure this out and calculate it. It's called the capital asset pricing model and the security market line, and it uses a concept called beta, which we'll talk about a little later. Now, as I said a minute ago, there's two types of risk, two broad types of risk. Okay, there's many angles to look at risks. So I don't want to tell you there's just plain old two types. There's more to it than this. There's standalone risk. Standalone risk, and that's the risk of an individual stock all by itself. You hold a portfolio of one security. And so you can have a portfolio of one security, just like you can have a paragraph with one sentence or a sentence with one word. You can have a portfolio with just one stock. Normally we think of portfolios as having many stocks to it, but you can have a portfolio of one. And you have a portfolio of one and you're looking at the risk of that portfolio. It's called standalone risk of that particular stock. It's measured by a thing called standard deviation, denoted as sigma in your textbook. Sigma measures how spread out your returns are going to be. So in statistics, you had, for example, an x-axis or some type of axis here. You could have been looking at what's the average lifetime of it, what's the expected lifetime of a light bulb, for example, and it may be 1,000 hours, and you would put 1,000 here, and then you would have hours on this axis, right? But this is not a statistics course, although we're going to rely heavily on statistics. This is a finance course, so it's not hours, it's going to be returns on this axis. And the standard deviation is going to measure the spread of returns, not the spread of the variance of the number of hours a light bulb lasts. Some light bulbs last way over 1,000 hours, some of them burn out in 200 hours. Here we're worried about returns. And in the middle here, this measure of central tendency is your expected return, R hat. So R hat is what you expect to get, but hey, look, there's risk measured by sigma, which measures how spread out this distribution is. So here you have a fairly risky stock. Here you'd have an even more risky stock that's spread out. Same mean, same expected return, could be 12%. But this stock, you could have huge losses or you could have gigantic gains up on this end, right? So we're going to apply this distribution to returns in this course. So that is the first type of risk. The other main type of risk is portfolio risk. So standalone stock by itself. Here we have a portfolio. When we say portfolio risk, we're really saying a portfolio of many securities. And we're going to measure that primarily through a concept called beta and the capital asset pricing model. Okay? That'll come in a little while. So let me talk about standalone risk and then portfolio risk, and then we'll get into beta. I'll show you an example. Here I have an example of several stocks. Let's look at it carefully. And several stocks and a T-bill. Here is, so we're really, what we're looking at is expected return and the risk going into the future. And so we're looking at an economy that could be strong next year, it could be weak next year, or it could be normal, meaning normal, a little bit of growth, which is normal, or you could have a weak economy. The probabilities of a strong, normal, and weak economy are 30%, 40%, 30%. They all add up to 1, which means we've covered all the situations that we could have in the economy. Obviously, the economy is not just couched in 3 categories. There's actually an infinite number of probabilities out there, but we're going to keep the math easy. We'll just put it down into 3 areas. Now, I have a number of different stocks listed here. Look at this. This is high-tech stock. High-tech stock, think of it as, it could be, in the biotech industry, you know, like Biogen. It could be, you could think of Apple being in there. You could think of computer stocks, companies that are on the leading edge in the technology area. In this high-tech company, look at it. In a strong economy, you expect to get 60% out of the stock. In a normal economy, 15%. And if the economy goes into a recession and is weak next year, you'll lose 30%. So the expected return here is going to be, for this stock, the expected return is 15%. Standard deviation is about 35. So how did I get 15% expected return? Well, the 15 expected return is R hat, and we'll call this high tech, HT, is 30% weight times the 60% plus 40% weight times the 15% return plus the 30% times the minus 30 will give you 15% is what we expect to get. So again, that's sort of like a measure of central distribution, basically saying 15% for this stock. Now, the standard deviation for this stock, sigma high tech, is calculated like you did in statistics class, somewhere in your statistics past. It's calculated this way. First, we calculate the variance, which is basically return squared. But really what I'm trying to do is I'm trying to measure the spread here in the distribution. And the way I'm going to do that is I'm going to take the weight of a strong economy, right, 30%, and I'm going to take the return that you get, high tech gets in a strong economy, 60, minus its expected return, and square it. So I'm taking this, how far, basically I'm saying, look, I got a 15 expected return, and there's a chance that I get a 60% return here. I'm taking this distance here, and I'm squaring it. Because if I don't square it, I'll show you a concept here, basically. I can show you another way. If you got a stock that wiggles around like this over time, and you calculate its average, and the average would go right down the middle, right? If you were to take this deviation, this deviation, this deviation, you'd add up these deviations. Those deviations would add up to 0, which is basically the same as flip this. Think of this as a distribution that kind of looks like this. Okay? So you got a distribution, and you got the expected return here. These are negative deviations from the mean. These are positive deviations. They all add up and sum to 0. Just like the sum of these deviations add up to 0. You don't get anywhere, so you got to square them, and that's from statistics. So that's why I'm squaring it. And so I'm taking that deviation, and this is risk, by the way. Think about it deeply. This is risk. When you deviate from what's expected, it's risk. Even if it's positive, even if you're deviating from a positive angle. And some people have problems with that, but that's the definition of risk when you have a symmetrical distribution. It doesn't matter if you're above or below this, it's still risk because it's symmetrical. So we're looking at a big deviation, squaring it, and then we're weighting it by the chance of a strong economy. We're going to add to that the 40% chance of a normal economy and a 15% return then minus a 15% squared. Now this adds up to 0 because in the bracket nets out to 0, so this has no weight at all because there's no risk, because in this category of normal economy, what you expect is what you're going to get, basically. So there's really no implication there. Then what we want to do is we want to take the 30% here and multiply it by the chance of losing 30% for high tech in a weak economy minus the 15, square that. There is certainly risk right there, because here you got a chance of losing a lot of money here. relative to what you expect. I mean, you're talking 45% below what you expect, and that's what's in this bracket here. Square it, adjust it for the probability, and what you'll get is, when you do this calculation, you'll get a sigma for high tech. And the sigma for high tech, I got it right here. It will be it'll be 1218. But the thing is, that's 1218 in returns squared, which basically I'm saying this is the variance of high-tech stock returns. It doesn't have a good intuitive feel, although we will use variance from time to time in this course. What we really want to do is take the square root and get it back into original units. Now look, when I have variance, what I like to do, and you won't find this in any textbook anywhere in the world, it's just my own notation. When I calculate a variance, I put 2% behind it. So it tells me, it's screaming at me that this is in percent return. This is in returns squared. Because look, I just squared the returns here, here, and here, and then I weighted them by something that adds up to 1. These are in returns squared. I want to get back to original units, because when I look at these normal distributions, I got to look at it in returns. This is not returns squared. This is returns. This would be 15%. I got to compare it to a standard deviation that's 15%. I can't compare it to a variance that's in returns squared. So I got to get back into original units, and then you can wrap your head around that a little better. And when you do that, you get the 34.9%, and that's where it earns a single. Look, it earns a single percent sign behind it because it's 34.9% standard deviation, which is, on the high side. For most stocks, that's high, and that's because we have a high-tech company, and the underlying reason for the returns being up or down is because it's in a risky business. Its portfolio of projects and investments and product line is quite risky. There could be a company that pulls the rug out from under it and just sweeps it away in terms of competition. Comes out, another company comes out with a new product and makes your, high-tech's, this company here, high-tech's product obsolete, gone. And so it's a tough industry, and it's often quite risky. And so in a strong economy, this would do well. In a poor economy, it would do really poorly. Okay, so that's how you calculate expected returns and risk. And I did the same thing across for all these other securities, which I invite you to calculate each one of these numbers at home and confirm. It may be helpful. You're certainly going to have to do it in a homework problem or a self-quiz or on a test, but you can always confirm this using an Excel spreadsheet, which is what I did. I recalculated it all in an Excel spreadsheet. Now, let me show you ex post standard deviation calculations, meaning after the fact. Okay, so when you're dealing with after the fact, you're not dealing with expectations anymore. You're looking backwards in time. And so the setup is slightly different, but the math is somewhat similar. So here we have years 1, 2, 3, and 4. I'll go 4 periods. And then we're going to have returns. Let's say we have a negative 7% return in year 1, 9, 4, and then 18. So the question is, and so this is, year 1, 2, 3, 4. Maybe we're in year 5 right now. So we're looking back in time. The average for this, added up, divide by 4, and you're going to get 6% average. Okay, arithmetic average. Now, what we want to do is calculate the deviations from this mean or this average. And so what we're going to do is we're going to take returns R minus R bar and square them. And so what we're going to get here is minus 7 minus 6 squared, right, is 169. And then we're going to take the 9 minus the 6 squared here, get 9. 4 minus 6 squared is 4. And then 18 minus 6 squared is 144. We add that up, we get 326 divided by 3. Now, to calculate the variance. Now, the formula for this, by the way, the overall formula for this is sigma equals the square root of the sum of the returns from the mean squared divided by n minus 1. So this is the formula I'm calculating. And so I calculated this to be R bar right here. Okay? And now what I did was I calculated the deviations. You see that? And that's what I just did. Calculated, and I summed them up. So here's the sum. Okay? And so this is the square root of 326 divided by 3. Now n minus 1, basically what I'm doing is taking an average of these squared deviations when I divide by n minus 1. Normally you divide by n to get an average, but remember from statistics that minus 1 degree of a freedom adjustment, which you don't need to worry about, but basically it's n minus 1. And I actually don't care if it's n or n minus 1, but we're going to follow the textbook, and the textbook shows us that the calculation is n minus 1. And that assumes a sample, if you recall from statistics. If it was a population that we were dealing with, then we would divide by n. Okay, so this this term right here is the variance. This is the variance. And when you take the square root of the variance, and that variance, by the way, is 108.67. When you take the square root of the variance, we end up with 10.42%. So 1% sign behind it. And that is an after the fact, ex post, in other words, calculation of volatility. We have returns that were going up and down over time in the past. We calculated the mean to be 6%. We took the squared deviations, because if we didn't square the deviations, again, they would sum up to 0 overall. Not quite drawn the way I drew it in this picture. They won't add up to 0, but they would typically add up to 0, so you won't get anywhere if you just sum up the deviations. You got to square them. You got to put that square term in, and then you unsquare it when you're all done. In other words, take the square root, get back, and now you're back into original units, 10.42% standard deviation. So let's take a look at the type of securities that you can hold in your portfolio and the implications in terms of risk for a portfolio here. Now, here is a counter-cyclical stock. Counter-cyclical stocks, this is what portfolio managers love to get stocks like this. Counter-cyclical. Counter-cyclical means it moves against these business cycles. So you have a wavy business cycle. Business cycle looks like this. Counter-cyclical stock means it's going opposite to some degree. Not perfectly like that, but it'll move opposite. So you can see right here that when we have a strong economy, this counter-cyclical stock is actually negative, has negative returns. Okay, returns under a normal economy. And then when the economy is weak and most stocks are doing poorly, this stock does well. So you can think of, what type of business would this be? Well, it probably would have to sell inferior type goods. You remember that from economics? Goods that when your income goes up, you tend to buy less of, and so some people think of fast food, hamburgers, although they're not really considered counter-cyclical securities. Maybe Dollar General and things like that. Dollar General store stuff that sells, where they sell very cheap generic products. This is more theoretical than actual. It is hard to find particular securities that are, quote, counter-cyclical. So it's there for a reason here. The world is looking for it, but it's more hypothetical. Now, a more realistic example of securities that you find in our stock market are cyclical securities. Cyclical securities means it's moving up and down with the economy in general. So let me show you here. So you have here's the business cycle and the market. This company is moving in sync with the market or the economy, and that's what you see when you have a strong economy. Cyclical does well. When in a weak economy, the cyclical does poor, and it makes a normal return in a normal economy, normal growth economy. And so you got averages here. But notice, by the way, look how compared to the high tech, the standard deviations are lower, because the volatility here that you have is much less. The spread in the distributions are smaller here and here than you have with high tech. So high tech is basically an exaggerated stock, especially compared to cyclical. Now here's the market return, right here, the market. And so in a strong economy, we assume the market, and the market is the average stock. So when you hear the word market, you should immediately think, okay, we're talking about the average stock in the market, in the economy. And so here we got 32% return in a strong economy, 12% normal, and -9 in a weak. And so we have an expected return on the stock market around here close to 12%, which, by the way, is not an accident. I put that in there because the stock market over the past 80 years has averaged around 11-12%, sometimes 10%, depending on the sample period you're looking at. But over the long run, the stock market does 10 to 12%. And then it has a standard deviation for the market here, about 16%. The last security that I have here, it's not a stock, it is a security, it's the T-bill. And with a T-bill, you must realize, we've talked about T-bills having no risk. There it is. That says no risk. It has a standard deviation of 0. So when you have a standard deviation of 0, you're looking at a distribution that looks like this. There is no spread. You're going to get 2% in this case. Here's the return. There is no spread in the distribution. And that's what this is telling you. There's no spread in the distribution. What you see is what you're going to get. It doesn't matter if the economy is strong, normal, or weak. You're going to get 2%, 2%, 2%. That is the definition of risk-free. Okay. Now, what we want to do is, now that we've looked at individual stocks, expected returns, and risks, standalone basically, let's look at it. Risks from a portfolio perspective, and let's look at returns from a portfolio perspective. Almost nobody has one stock in their portfolio. Almost nobody. Most people have, and if they don't have, maybe they do have one stock, but you wouldn't just look at the one stock. You'd be looking at your stock, and in theory, you'd be looking at your stock relative to the value of your house, relative to the value maybe of bonds or some other assets that you have. Nobody has just one stock. So, standalone risk is also a little more is more theoretical than actual for most people. So most people hold portfolios, and so let's look at the expected return on a portfolio. And I'll just do a simple one. The expected return on a portfolio, let's just make it up here. Expected return on a portfolio, that's what it says here. There's the symbols used in the text. So this says expected returns, and P says portfolio. Let's say we put half of our money in high tech and half of our money in, let's say, counter-cyclical. Well, half of our money, 50%, is going to have a 15% return, expected return, and half of it is going to generate an expected return of 5. So what is the average? Well, so what's this going to come out to be? This is going to come out to 7. This is going to come out to 10%. Oops, 10% expected return. Okay. You can pick this. So if you pick another stock and you put 10% in high tech, and you put 90% in the risk-free, you would come up with, let's see, 1.5 plus 1.8, you'd come up with 3.3% return for this portfolio made up of a T-bill plus a high-tech stock. Okay, so that's the expected return on a portfolio. It's simply a weighted average of the expected returns of the stocks in the portfolio. I'll say it again. The expected return of a portfolio is simply a weighted average of the expected returns of the stocks in the portfolio, where the weights always have to add up to 1, and the weights represent the percentage of your wealth or money that's invested in those stocks. And those weights always have to add up to 1. Okay. Now, let's look at portfolio risk, which is way more complex, and this is the heart of portfolio theory. This is what the world turns on in the world of the business world, not just in the world of finance, but the entire business world, the economy, the globe works, the entire international markets work this way. And that is the benefits that you get from diversification and the impact of diversification. So I'll give you an example, and I use conceptually these types of stocks here. You can think of it, and that's why I introduced to you counter-cyclical, cyclical, and things like that. You can have the best thing you can have from a portfolio perspective is to get a positive rate of return, right, with very little risk. And the way you do that is you tend to buy put together a portfolio of securities. And what happens is if you pick the right securities, you can eliminate a lot of risk if you pick the right securities ahead of time. So here I'm going to have return on this axis, time on this axis, and I'm going to say, let's say we got this stock. Here's the returns of stock A, right, over time. 1 year it's up, it's kind of down, it's all still positive because here's zero right here. And so it's wiggling around a lot. That's stock A. Now think of it as a cyclical stock. Okay, let's say it's moving up and down with the economy. Now let's say you bought a counter-cyclical stock. A counter-cyclical stock would look like this. Call it B. Okay? And so look what happens. You get the return at B goes up when A kind of goes down. So now if you look at these securities, their average returns, the average for each of these is best I could draw it. So the average, R bar, because we're looking back in time here, is, and you can think of it, sometimes it's helpful to think of R bar as, this is what you also expect to happen in the future. So if this is now, you would expect this to happen sometime in future time. So this is the mean going right down the middle for both of them. So the R bar for A equals the R bar for B. Okay, you see that the means are basically overlapping. You can see that. Okay. Now, so you can calculate that using the formulas that I showed you a minute ago. This type of formula where you put half your money in a security that's up, half your money in a security that's down, you're going to come right to the mean. But notice what happens. If you form a portfolio where you put half your money in A and half your money in B here, you're going to get portfolio return, okay, P, which is this right here. Notice the portfolio's return has no volatility in it. there's no variability. Zero, the way I drew it here, right? Because the return of A completely is offset by B. It's like, wow, check that out. That's really cool. The way I drew it here is slightly unrealistic because I didn't put any negatives. You know, in reality, you know, stocks come negative in 1 year, but not always. So here, you know, this could be a 10% return right here on average. So look what I just did. I formed a portfolio by, you know, putting half my money in a cyclical stock and half my money in a counter-cyclical stock. They offset. They both had a same return of mean of 10%, and that's what my portfolio's return. My portfolio had no risk. So the sigma of my portfolio is 0. That's what people in mutual funds and the stock market are looking for. They're trying to match up stocks that offset each other and still gain a positive return. Easier said than done, but that's what they're trying to do. Like I said, finding a counter-cyclical stock like I have in red here is you know, ex ante. In other words, before the fact. That ex ante means before the fact. You know, when you play poker and you ante up, you know, you ante up before you play the hand. Ex post is a term that I'll often use, meaning it means after the fact. Ex post. Okay, so ex ante, trying to find a counter-cyclical stock is more theoretical than reality, but it doesn't stop people from trying to find them. And if you can get this result, and that is a dream of a portfolio manager. Imagine telling your clients, you know, you manage a $1 million portfolio, and the $1 million portfolio just went to $1.1 million because it went up 10%. And you tell your clients, I just grew your portfolio 10%, $100,000 with no risk, which is what that's saying. So this is a little unrealistic, but this is what people are looking for. And sometimes it does happen, but it's hard to put a portfolio together that does this. Now, you could have other types of securities that are, let's say you buy 2 cyclical securities. If you buy 2 cyclical securities, they're basically doing this. They're moving up and down along with the business cycle, and together their returns are, you know, darn near close to each other, right? Their average returns. And so when you put a portfolio together, right? When you put a portfolio together of these 2 securities, so this is the average return. Let's call this A and B. They're really close. I'll make them equal here. Okay, and when you form a portfolio between these 2 securities, let's say this is 10%, you're not going to get, this is not going to happen when you get the portfolio return. If you put half your money in A and half your money in B, you're going to get this. Let me show you. Your portfolio is going to look like this. Your portfolio is going to have the same amount of risk and the same amount of variability as each of the individual securities do. Okay? These 2 securities have what we call a correlation. And the textbook will use a rho for correlation. We'll have a correlation coefficient of +1. When you have a correlation coefficient of +1, it means the stocks over time are moving perfectly in sync with each other, and there's no benefits of diversification. No benefits of diversification. Diversification meaning, the benefits of diversification meaning risk reduction through the offset. There's no offset going on here. Your portfolio is just as risky as the individual securities. Now, in this case, we had a complete offset. The rho in this case is -1. Okay, the correlation. When one's high, the other's low. High, low, high, low. And so you get maximum benefits of diversification when rho is -1. So remember from statistics, you got to remember that that rho goes from -1, right, to 1. Do I have that right? So in other words, the range for rho is -1 to +1. I just showed you there's no benefits to diversification, none, right? And I'm telling you there's maximum benefits of diversification here. And as you move in this direction, you get more and more benefits of diversification. You could have a correlation of 0, and it's really hard for me to draw a correlation of 0. It's impossible. I mean, it's really hard to draw these correlations that I drew here, but you get the drift of what I'm saying. Correlation of 0 means that the two are moving. I can't even see. I can't draw it right. The two are moving. They're independent of each other. They're statistically independent and unrelated to each other. And that would be a correlation of 0. Okay? So in the world of portfolio management, people are trying to move in this direction. They're trying to find securities that do this. Trying to find securities or close to this as best they can. That means they're moving in this direction. And so what does that mean? Well, how do you translate that? Well, what it means is you find stocks that are not in the same industry and put them in your portfolio. If you find a bunch of cyclical stocks, they're all going to move together like I have here. You're not going to get benefits of diversification. You're going to be way up here. Now, what if you were to buy, Coke, and you were to buy, let's see, Shake Shack. That's a food company. You can buy General Motors. You can buy Motorola, or some Japanese company or European company in a completely different industry. Then what you're doing is you're moving in this direction. Those individual stocks have probably decent expected returns, but when you net them together in a portfolio, when you put them together in a portfolio, you're moving in this direction. So you also would want to go, don't even think about just stocks. What about bonds? If you buy bonds, well, they're going to be even less correlated, and you're going to move in this direction. What about real estate? You can even throw real estate in your portfolio. And real estate's going to be less correlated than individual stocks, and even probably less correlated than bonds. And so you can move in this direction. And not only that, you could buy real estate in foreign countries. And so the more you diversify, the more you try to move in this direction, the more you have offset. Because there's no reason to expect that the real estate in China is going to move in sync with the real estate in Brazil or in Germany. So that's the benefits and the power of diversification that's central to finance. Remember, in finance, everything boils down to risk and return. And look, that's basically what this chapter is about. This is the heart of finance. Now what I want to do is I want to show you the benefits of diversification using another graph. You can't pick up a finance textbook anywhere without seeing this graph. I call it the sliding board graph, as you'll see in a minute why. Basically, we have risk on this axis, and here we have the number of securities on this axis. Think of it as the number of stocks. You can think of this in terms of stocks. It's usually conceptually best. Although, like I was hinting towards a minute ago, you can think of this as stocks, bonds, real estate, and all sorts of other securities. Stocks are probably the easiest thing to wrap your head around. So here we start with 0 stocks and 0 risk right here. 0, 0. Now, when you have a portfolio of just one security, you have a lot of risk. You get a lot of risk. And if you were to randomly select a second security, randomly, then you would have the combined effect is you would have less risk, a little less risk. And if you put 3, 4, and you kept doing that, randomly adding securities to your portfolio would come down. In fact, it would come down even steeper. Let me give you, draw that over for you real quickly. It would look something like this. Here's number of securities, 0, 0. Here's risk. It would come down like this. It would come down faster is what I'm trying to show you here. But notice what happens is you randomly add more and more securities to your portfolio. A couple things happen. First of all, as you move in this direction, you start to look like the market. In other words, your portfolio begins to look like the market because you're adding more and more stocks. You basically mimic the stock market as a whole as you move in this direction. So notice what happened is, and the reason for me to redraw this quickly is that the first several stocks that you buy have a dramatic impact on cutting the risk of your portfolio down. So this is the risk that your portfolio bears. It's sometimes called total risk. Okay? And that total risk doesn't ever fully wash away. I mean, notice it didn't go to 0. I didn't draw this down all the way till it touched this line here. It's up here. And so what that tells you is that even the stock market has risk. And I think you intuitively know that. The S&P 500, if we use that as an example, as a proxy for the market, it's 500 stocks. It's a reasonably good proxy. It's not perfect. But that S&P 500, look, that goes up and down. Sometimes it goes up and down 20 points a day. It goes up 1 to 2% up and down in any given day. And so there's risk in the S&P 500. You could lose your money in the S&P 500 in a given year. You can make a 40% return in 1 year. You could lose 40%. So there is risk. So the point is, when you have a diversified portfolio, you get rid of a lot of risks. This risk right here in this area is called diversifiable risk. Diversifiable risk. It's risk that can be diversified away. It's sometimes called company-specific or idiosyncratic risk. And here's a whole bunch of terms that pop out, and I can't help it. It's just the way the world of finance operates. They call this risk a number of different terms. And like I said, it's diversifiable risk because you can get rid of it through diversification. It's company-specific because what goes on and happens in one company that's positive, there could be something else in another company that's negative. And so it's risk that nets out. It's company-specific. It's idiosyncratic, meaning very company-specific. These are just terms that are used in finance to describe this. Okay? And it's risk that you can get rid of. Now, this is often measured, by the way, as sigma, as your measure of risk, and your portfolio, sigma of your portfolio would drop dramatically. In the first 10 stocks, if you truly randomly select them, you'll drop off a lot of risk in the first 10 stocks, and then they'll start to flatten out. You won't get as much benefits of diversification. So if you own all 500 stocks in the S&P 500 and you throw another stock in there, you're not going to get a whole lot of extra benefits of diversification. You'll get an itty-bitty little bit, is what I'm saying here. Now, this right here is the sigma of the market as a whole. So this is the standard deviation of the market. And so, like I said, individual stocks, you're going to tend to be highly variable, and then they'll tend to reduce and come down. And what you end up bearing is called market risk, sometimes called systemic risk. Is this area right here, from here to here, is market risk. This is risk that you can't diversify away. So sometimes it's called undiversifiable risk, because you can't diversify it away. It's market risk. It's systemic, meaning no matter what you try to do, you can't get rid of it in normal circumstances in a portfolio. So this systemic risk is the risk of, say, inflation going wild, international things like the value of the dollar and currencies and international trade, interest rates across the economy, the economy's health overall, things that the Federal Reserve chairwoman, and the president, for example, are concerned about. Those are market risks, systemic risks, systemic things that you can't get rid of through diversification, and you have to bear those risks. But notice what happens. Notice what happens here is that when you diversify, you get rid of a lot of risk, right? This diversifiable risk, you get rid of this company-specific risk, but you still manage to keep an expected return that's positive. So look what happens. It's kind of like this going on through diversification, but you still keep a positive expected return. So that's the magic and the benefits of diversification. You still get a positive return. The S&P 500 still generates about a 12% return, but you've gotten rid of all this risk right here with the S&P 500, and you still managed to keep a decent return of expected return of 12%, say. Okay. Now, let's continue. We need to find a way, something to measure this risk. And over the years, we've developed in finance models to model this risk. And by far, the most popular measure of this risk, and to try to capture the risk and return of holding well-diversified portfolios, which, by the way, what I just told you implies something really huge. It implies that there's no reason for you to hold really small portfolios, because diversification is basically free. The costs to diversify, transactions costs and so forth, are really, really small. And you can buy in one click exchange-traded funds and mutual funds on the internet, where you can buy 1,000 stocks in one click. A total market portfolio, you can buy 2,000 in one click. So you get like instant diversification with hardly any costs. And basically, it can ignore the costs. And so you can ignore the costs. There's no cost to diversifying and moving in this direction. But you still keep expected return up. So again, that's the magic of it. So what we want to do here is we want to find a way to measure this market risk. This is the risk that we're exposed to. We can't get rid of. We don't really want to measure company-specific idiosyncratic risk. We can. We measured it by sigma, but there's no reason to hold that type of risk, because that risk should net out in a well-diversified portfolio. So what we're going to do is we're going to look at what's called the capital asset pricing model to try to measure this risk and the return associated with it. So this is called the capital asset pricing model. And funny thing is, it's called capital asset pricing, but it's really using returns, not prices. Although returns indirectly will tell you about prices. It's just don't get hung up in that terminology. Okay. And what I'm going to do is we're going to draw an equation for write out an equation. So for this, so this model says, look, the required rate of return for an individual stock, given its risk, the required rate of return is going to equal a risk-free asset rate of return plus a thing called beta times the expected return on the market. That's a little subscript M, if you can't see it. It's a little subscript M minus the risk-free rate. This is called the security market line, that equation, because I'm going to graph this line in a few minutes, and you'll see the relationship here. Now this is beta. This measures the amount of systemic or market risk. Okay, this guy right here, this is the expected return that you expect to earn over the risk-free rate. Now the risk-free rate is a very low rate of return because it has no risk, and so people don't expect any risk premiums in there. Remember that from chapter 6 on interest rates. But the market here, stock market, you bear risk. So this difference, which could be, say, example 12% minus 2%, that would be 10%. This is called the market risk premium right here. It is a risk premium because it's the amount of risk, it's the amount of return you're getting for the risk you're taking in the stock market. Okay, this term right here is market risk premium. Beta measures the amount of risk that you're bearing. How much risk how much systemic risk does your stock bear? And then you have the risk-free rate. So if you have no risk at all, if you have no risk, like the T-bill, then your beta of a T-bill is 0. The beta of a stock, if you can find the beta of a stock that's 0, this whole side washes away, and then your required rate of return given the risk, there is no risk, is equal to the risk-free rate. And notice what happens is, as beta goes up, then the required rate of return given the risk, and what is the risk here? Remember I said earlier, required rate of return given the risk. Well, what is the risk? Market risk, measured by beta. Now, maybe a graph will help you with that security market line. It looks something like this. The security market line, we have beta on this axis. Now, here's a point worth noting. Many people think that, and the way I drew this, it looks like this is the slope of the equation. In fact, your textbook actually puts it on this side, and they put this market risk premium on this side. So it doesn't matter if it's A times B or B times A. It means the same thing. But they put it B here. This is actually the slope of this line. This is the slope. B is not the slope. You're used to math and in various algebra courses. You'll have B here, and it represents the slope. It's technically not the slope because, look, I got it on this axis, so it's not the slope. Now, on this axis is the required return. Required given the risk. And where's the risk? Here. So this graph is required rate of return against risk. Okay, required return against the risk. It's sometimes called the risk and return plane. See, it's a plain piece of paper, flat piece of paper like a plane. It's not three-dimensional. And so here we have the risk-free rate. So when you have 0 risk, like in a T-bill, so when I gave you that example of a T-bill way back here, notice there's no systemic risk in this T-bill. There is no risk period. There's no standard deviation. This would have a beta of 0 because it doesn't move with the market. So this would be, make up a number of 2%. Okay, right now it's less than that. It's less than 1% in today's market because T-bill. This is basically a T-bill rate, and that's less than 1% today. Now, this equation for this line is the RF plus the beta times the market risk premium. Okay, so the slope of this line is this. This is the slope of this line. Okay. The intercept is here. Okay. Now, how much market risk you take moves out in this direction. The more market risk you take, the more further you move out here. Notice, the more risk you take, period, the more return you demand. The more return you required, given the more risk. So it's upward sloping. It has to be upward sloping or it wouldn't make sense. We're assuming here that individuals are risk adverse, which is a very good assumption on average, especially when it comes to retirement money. People are risk adverse. Now, there are people, by the way, as you know, that are not risk adverse. They're actually what's called risk loving or risk seeking. We're not talking about those people here. Some of those people would be Vegas people. Gamblers are to some degree. But when you go to Vegas, you're not really doing investment management. You're not really thinking this. You're investing in the stock market. When you invest long term in the market, you're generally risk adverse, and on average, people are risk adverse. Lots of studies have shown that, and they're risk adverse to varying degrees. Some people can take a lot of risk and be highly have very low risk aversion. In other words, they're still risk adverse, but they can tolerate a lot of risk. There's other people who can't tolerate hardly any risk. Okay? So notice the slope of this line is determined by how much the market return, what people determine. This is determined by the overall economy, and investors across the entire stock market determine that. They also determine the risk-free rate, because they're buying and selling treasury bills, and supply equals demand, so on and so forth. And so, okay, so here we have the security market line. Now, it turns out in this model that the average stock has a beta of 1. So that means as soon as you hear the word average stock, you're basically thinking the market. So the stock market, like the S&P 500, has a beta of 1, defined to be a beta of 1. Now, if you have a stock that has a beta greater than 1, say 1.5, that means the stock is 50% more volatile, has 50% more systemic risk than the market. If you find a stock with a beta of 0.75, it means it's 75% as risky as the market, which means it's 25% less risky than the market. It has 75% of the risk of the market. So that's how you interpret it. This is your benchmark. So if you come up like this, and you bounce off of this line, this has got to be 12%. If we're saying this is 2 plus the market has a beta of 1, and the market has a return of 12, and the risk-free is 2, this equals 12%. Okay? This equals 12%. And here we are, 12% with the market. So this is RM. And there you have it. If you find the stock with a beta of 1.5 in this model, then it's 2 plus 1.5 times this. That's what, 15? This will be 17. So you come over, this would be 17% in this example if you had a beta of 1.5. Now let's look at this a little more carefully here, graphically. So here we have the market. Right here is the market risk premium. In fact, I think the textbook just calls it RP. I like to put an M there to tell you that it's the market risk premium. And here, for example, and I put an M there because I want to compare it to, say, this particular stock, and I just made this up to 1.5 beta for individual stock I, for example. That is a risk premium for an individual stock, for sure. That has a higher risk premium because this stock bears more systemic risk than the stock market. So you can have, this is the average stock as measured by the stock market. You can have stocks that have betas higher than the market. You can have stocks that have betas less than the market. Okay. Now, your textbook goes through some examples. It says what happens if you have an increase in inflation, and if you have an increase in inflation, what happens to the security market line? Typically, all else being equal, an increase in inflation means that the whole thing shifts upward, a parallel shift upward. And then your textbook will say, well, what happens if people's risk aversion changes? Which means their risk aversion in the overall economy changes. It means the slope changes because what they demand for a given amount of risk changes. So they may, if they become more risk adverse, then this slope may actually rise. The slope may actually go up. Or if they become less risk averse, it could actually become flatter. So your textbook goes through various examples of that mathematically. So keep that in mind. One thing I wanted to talk about is, again, the benefits of diversification and the sliding board graph that comes down. Okay, don't forget, we're measuring market risk. This is the market risk. Here we're looking at the premium you get for the market risk here, because this is return on this axis. This is strictly risk on this axis right here. This is the number of securities on this axis. Okay, this is diversifiable company-specific risk in this area here. Okay. Now, one other thing about this graph is that if you start to invest in, so if this was just plain stocks in the stock market, you'd be here. But if you were to start looking at add international stocks, so when we say domestic right here, if you buy domestic stocks, this is the benefits of diversification that you'd get. Now, if you went internationally, you could actually get less risk, come down this way. And so this would be your level of international market risk. And if you add real estate to the picture and bonds and so on and so forth, you can come down even further. But there's a limit to how much risk you can get rid of. You're still going to have some risk that you can't get rid of. You can buy a portfolio that has hundreds, if not thousands of international stocks. It can hold real estate from around the world, bonds from around the world, commodities like gold and silver from around the world, and you'd still have some risk. So you can't get rid of risk completely through diversification, but you can get rid of a lot of it. Let's go to a real-world example to show that we can actually use this security market line, the capital asset pricing model, and the concept of beta. And so what I did was I went to the Wall Street Journal. See on my left here, I got a sliver of a window from the Wall Street Journal, market data. Here we have Treasury securities, and here's the Treasuries from 1 month to 30 years, and here's the yield. Look, the yield for 3 months, and that's typically the risk-free rate that we use, is a 3-month annualized T-bill. That is 0.008%. That says, in English, basically, the interest rate is 0. The opportunity cost of money is now 0. You can see that in the yield curve that we've seen earlier in Chapter 6. So yield first 6 months, basically 0. Interest rates ramp up to just under 3% at the 30-year mark, which is what you see up top here, 2.8% at the 30-year mark. Okay, so we really want to focus in on this guy. That's our risk-free rate. Now, to the right here, I have from Finance Yahoo Finance, I pulled up Apple statistics. AAPL is the Apple ticker symbol, and the price was $110.39. And what we want to focus in on is right here. And nearly every stock will have a beta. Mainly the big ones. Sometimes the really small ones won't have a beta. Small companies. But there we have a beta, and that's an estimate of the beta looking back in time. The Finance.Yahoo doesn't have a crystal ball as to what things are going to look like in the future. Technically, when we put this security market line together, we should be using a beta that we forecast into the future. But nearly everybody looked backwards and looks back to the calculation here. So we have a beta here based on historical information of how Apple stock's return behaved relative to the overall market. And we got a beta of 1.09, and that's not 1.09%. What this says is, be careful of the interpretation, this stock is 9% more volatile, has 9% more systemic risk than the market. So it's 9% more volatile than the market. Okay, so remember, the average stock, which is the market, has a beta of 1. This is a beta of 1.09, so it has about 9% more systemic risk than the average stock. So now let me go back, like I said, let me go back to paper and estimate the required rate of return for Apple given its risk. Well, let's assume for rounding purposes, the beta is basic. The risk-free rate is 0 for the economy at this point. The beta of Apple is 1.09. Now, what do we think the market return ought to be? What do you expect? This is the expected rate of the market over the next year. Well, we've talked about this a bunch of times. It historically is 10 to 12%. Let's make it 12% this time. Put 10 if you like, but I'll put 12. The risk-free rate's 0. So let's calculate what is the return that the market looks for Apple. It is 13.08% is the expected return on Apple given its risk, or the required, sorry, make sure I say this right, the required rate of return on Apple given its risk. And this is what we require, and it's also, I should be careful, it's also what we expect to get. If we believe in the model that we have, then we would expect and require this to be 13%. So graphically, beta, return, required return. Here we have security market line. Beta of 1.0 is the market. Did you see the mistake I just made? I just made that this was that there's an actual intercept. The intercept is 0. So let me redo that. Basically, it looks like this. I'm not used to drawing a security market line that goes through the origin here, but it's basically right there with 0 for an axis. The stock market has a beta of 1, so you come up and over, it's 12% according to what I just told you right here. And Apple has a beta of 1.09, and we come up and we come over and we expect 13.08. And so the return that you're getting from Apple, it's all risk premium. There's no risk-free rate. Now, I haven't told you, and it's a good point to bring up right now, is why is that risk-free rate in this formula here? Why is this risk-free rate in this formula? If you have no risk, let's say, for example, no risk with a beta, then the return that you expect to get on a security is going to be the risk-free rate, like the T-bill, right? So why is this even here? Well, that represents, recall, the opportunity cost of money, of investing your money. If you want to buy Apple stock, you're going to have to take money out of that account somewhere and buy the stock. So you're going to have there's an opportunity cost because that money in an account could earn interest somewhere. Well, it turns out that the add interest in that account in today's market is basically 0. But under normal circumstances in a normal economy, this is a couple of percent. You know, most of the examples in a textbook are 5%. And historically, that's where the market has been for the risk-free rate, the treasury market. But that represents the opportunity cost of money. But there is no opportunity cost of money in today's environment. So the entire return that you get from Apple is simply because you're taking on risk of buying Apple stock. And the risk specifically has to do with the market risk. So here's the market risk premium, which reflects the risk of the market. Now, this is 10%, about 9% more risky, so you're going to get that little extra 9% right here in this area right here. Captures that additional return that you're going to get because you've taken on this extra risk. One more thing before I go here, wrap up this video and this chapter, is the beta of a portfolio. The beta of a portfolio is simply a weighted average of the betas of the stocks in the portfolio. So we have weights, say for stock 1 times, the beta of stock 1 plus the weight of stock 2 times the beta of stock 2, and so on. That is the beta of a portfolio, simple weighted average of the betas of the stocks in the portfolio. Not too difficult. So if you had let's say stock A had a beta, stock A had a beta of 0.75, and you got 25% of your weight in that stock, and the beta of stock B has, let's see, that beta is 1.20, and you have 30% of your money invested in that stock, and you have the beta of stock C with a 1.9 beta, quite volatile. And let's say you have 45% of your money in there. Notice that 100% of your money is accounted for. Okay. What is the beta of this portfolio? Beta P equals 0.25 times the 0.75 plus 0.30 times the 1.2 plus 0.45 times 1.9, and we get about a 1.40 beta. It's simply a weighted average of these betas, and the weights are the market value, how much money you have invested in each security.